Let's start off with who Evolution is, and with regards to the size of the company. We know that one of the biggest, perhaps, positives for you is the investment and asset management side of things. We know that you are going to be embarking on job cuts. The UK economy is in the doldrums at this stage, so give us a sense in terms of what is happening there.
Okay, Evolution is an investment bank and private client asset manager. It owns a company called Williams de Bro, which is a long-established private client asset manager. It was established in 1999, and Williams de Bro is a lot older, but it bought Williams de Bro and a number of other boutique asset managers over the last 10 years. And it's in a particular space in the UK market. There are very few assets of that type, particularly private client asset managers, that one can acquire. It's important for us to build that side of our business, as we've said historically, that we see ourselves building a lot more asset management and wealth management type revenues, as opposed to banking revenues, as banking revenues are difficult in this kind of environment.
Was the Williams de Bro asset what really lured you to take a look at Evolution?
Yeah, I think from our point of view, obviously that was the jewel in the crown, but there were elements of the investment bank which we thought would add value to us, and you know, the areas that we don't cover that they cover, and we're both mid-market franchises in the UK, and it ups our game in the mid-market space. It adds a whole host of corporate clients to our investment bank. In addition to that, the areas of expertise that they have that we didn't have.
Stephen, two questions simply. Is this a way to expand the business to go and buy? And secondly, what's it like in the UK? How are things going there? Okay. Not your company, just the general economic environment.
I'll answer both questions. Yep. I think that we clearly try and build our business organically. But there are elements of the activities we conduct which are quite difficult to build organically, in particular the private client wealth management space. If I have 50 years to go, well, you know, we can build another 8–10 billion pounds of assets. In asset management, we managed to build that a lot quicker because that's more institutional, and if you've got your brand and your franchise right, you get big flows. But to pull a private client away from another wealth manager is very, very difficult. Okay. We have a sound platform, and we integrate this front end of the business on top of our platform, and we get a lot of synergy over time.
We know the FTSE is sitting at levels that we last saw in 1999, but we also know that there are a lot of risks ahead.
Below 1999.
And 1997 or so.
Yeah.
And this is the kind of level that we're sitting with right now. They say the markets are cheap, but the risks are a very big issue at this stage. Do you think that this is the right time to go ahead and buy businesses at this stage? Obviously, it's a silly question in the sense that you have gone out and bought something or you're interested. What about regulations? What about Basel III? What about capital adequacy? Are these not concerns for you?
I think if I start off with the latter 2 points, I think that this is a low capital intensive business, therefore it uses very little capital, and therefore it's capital enhancing for us because it generates capital free revenue. So I think that's the first big point. Once you get the synergies through, the revenue that comes through is capital free. I think obviously the UK is a tough place, to answer Wayne's original question. I don't think it's as bad as people think. There are a lot more opportunities in the UK to do value enhancing deals than there are, for example, in South Africa, because UK had dislocation, South Africa didn't have dislocation. And therefore, you know, we're always a firm that has done well in a dislocated market. When everyone is buying everything, this share was valued at £400 million, you know, not much longer than a year ago, the value of the firm. So, you know, if we try to buy something like this in good times, it's highly leveraged to the market and you pay a fortune. I know we might have a higher value in our own share price, but you still would pay a fortune headline price for a deal like this.
With regards to yesterday's price, 6.6% premium essentially is what you're looking at this stage when you look at the $374 million. With regards to the 30-day weighted average price, we're looking at a 50% premium. The market didn't really respond today. We know that the market overall was under pressure, so Investec was down around 1%. Give us a sense in terms of the price that you're paying.
No, we think we're paying fair value. I don't think you can buy good assets cheaply. You know, this is not a world, even when things are undervalued, that you can buy good assets cheaply, particularly those types of assets which are very difficult to build. So I think, you know, we're on the button in terms of price. And, you know, we think that over time we'll get quite good value out of it, but there's a lot of work to do. It's not a plain sailing, and we've done it many, many times before. And if you think about some of the businesses we built them in the tough times. If you think about our private client wealth businesses, the others that we have, what was Rensburg Shepherd, we bought that in 1994. The UK was terrible in 1994. We bought our bank in the UK in 1992. Again, it was a very bad season. If you remember, they nearly got kicked out of, or they tried to go into Europe and they pushed rates up to 15%, and then they decided not to go into Europe at that time because life was so tough there. So, you know, I think that when there are opportunities, you've got to take them.
Yeah. Stephen, you're a lot closer than what we are down here in the southern tip of Africa. What's going to be the resolution of the European crisis? Where are we going to end up, in your view?
Yeah, look, I think that the dismantling of Europe is so difficult and so problematic that at the end of the day, you know, the key player in this whole matter is Germany. And that at a point in time, Merkel is going to have to step up to the plate. Otherwise, Europe is going to collapse. And how you extricate a country from Europe is very, very problematic. What do you do with Greece? Do you redenominate all Greek assets from euros into drachmas? I mean, you had an example when Czechoslovakia split up. And, you know, the one side was perceived as strong, the Czech Republic, the other side was perceived as weak, and you end up all the money flying from the weak to the strong, and it caused havoc. So I think they're mindful of that. I think they do know what the resolution is, but I think politically there's weak leadership, and politically it is very difficult for them at this point in time.
From a book value perspective, what are you paying for this asset?
From a book value perspective,
yes. What are we looking at?
What do you mean by book value?
Well, just tell us about in terms of
it had
net asset
130
value,
million pounds of net asset value, of which 110 was tangible, and we're paying about 230. So we're paying, if you said 100 million pound premium to book value, 120 million pound premium to tangible net worth.